So in this video, we want to proceed our discussion on financial instruments. We've already looked at the introduction and how to recognize financial instruments in our previous lessons, and we've also looked at how to classify financial instruments. We said that when we talk about financial instruments, it's always a contract, and this contract gives rise to financial assets of one entity and financial liability or equity instruments of another entity. In our first video, which is financial instruments part 1, we've looked at how to recognize financial instruments, the distinction between financial liability or equity instruments. And in our subsequent video, which is financial instruments part 2, we have looked at financial liability, what it is, the two classifications of financial liability, how we account, how you measure initially and subsequently measure financial instruments. We've looked at all that in our previous lessons. In this lesson, we are going to focus on another type of financial instruments, which has to do with compound instruments. So this video is devoted purposely for the discussions on financial instruments, and a very typical example of that is compound instrument. I indicated from our earlier videos that the compound instrument is not mentioned in the definition of financial instruments, but it forms part. It's one of the most important type of financial instrument, and it's something that entities do encounter in their day-to-day life. And today we will look at what are the examples of compound instruments, what they are, how you initially measure them, how will we even split them, and the other complications or other provisions on how IAS 32, IFRS 9, and IFRS 7 treat compound instruments. Alright, so please do subscribe, please do share with others so that we can increase our learning community. We are always grateful for being with us, for learning with us. Alright, so the focus for today is compound instruments. Compound instruments. Compound instruments. So here I'm going to denote it with CI, indicating compound instrument. What is it? A compound instrument is a financial instrument with two components. So when we talk about a compound instrument, it's also a type of financial instrument with two components, with equity component and liability component. So numerically, when we talk about compound instrument, or algebraically, you will see that compound instrument is equal to the equity component plus the liability component. Let me add C to indicate equity component. So when we talk about compound instrument, it's an instrument having two components, and these components are equity component and liability component. That is a basic definition of compound instrument. What are some of the examples of compound instruments? A typical example of compound instruments are convertible loans. They are convertible loans. So we can have convertible bonds. We can have convertible loan notes. We can have convertible preference shares. We can have convertible debenture. So all these are types of compound instruments. Now you have to be careful here. Most of the times, these compound instruments I've mentioned are issued, not even most of the times. The entity issues these compound instruments. The entity issues these convertible bonds. So they are seen as a liability. This is the idea behind compound instruments. So let's say for instance, A wants to raise money, and A is issuing a compound instrument. Let's be specific. Let's say a convertible preference shares. What it means is that this convertible preference shares is issued, and since it is issued, if you remember our keywords to indicate a financial liability, then it is issued. So then that means this whole thing is supposed to be seen as a liability to A. But the component, so here we have the equity component, and then out of this convertible preference shares, we have the equity component, then we have the liability component. Now, after you are able to split the equity component from the liability component, the holder, B here, is having the option, is having the right to convert the liability component to a given number of ordinary shares or equity instruments. So the holder of such instruments, they have the right, in fact, they can convert the liability component to ordinary shares of the entity. That is the basic idea behind compound instruments. The liability component can be converted into shares subsequently, either at the maturity date or either before the maturity date. And we take a practical example to establish that understanding. So, compound instrument has equity component and liability component. And the liability component can be subsequently converted into what? Into a certain number of shares. But one thing that entities or even shareholders will not always allow to, or will not always, accept, is to convert these loans into shares. The reason is that it's going to dilute their capital structure of the business. Is it going to dilute their voting rights? The existing shareholders will always opt not to convert the liability component into shares, because if that is happening, they are going to have a new shareholder. This new shareholder is going to dilute their existing capital structure, their existing voting rights. So most at times, the shareholders or the entity will object to the liability component being converted into ordinary shares. Ordinary shares. All right. So if you are following the discussion so far, you should be able to, establish your understanding on what a compound instrument is and the various types and the principles behind compound instrument. Now, our focus is this compound instrument that the entity has issued. How will the entity split it into the equity component and liability component? How will the entity ascertain the equity component and liability component? That is going to be the next focus of our discussion. So, an entity issued a compound instrument. This is one. You will be provided with information. You will be provided with information to determine the liability component. So, most of the times when you are faced with questions with compound instrument situation, you will be given a compound instrument and will be provided with an information to ascertain the liability component. Once you are able to ascertain the liability component, then we can say that our equity component is equal to the compound instrument minus the liability component. Now, the process of ascertaining the liability component or splitting the compound instrument into equity component and liability component is what we refer to as split accounting. Split accounting. So we split the compound instrument into equity component and liability component. Now let's take some practical process and see how we are going to, ascertain or determine our liability component. Any time that you are given a question, the question will come with two rates. The question will come with two rates. We are going to have what we call the coupon rate, or we call it the nominal rate, the nominal rate. Now, this nominal rate is what you are going to use to ascertain your cash flow. So you use the nominal rate, the nominal interest that the holder is required to pay. The nominal interest that the holder is required to pay. That comes with the coupon rate. Now, in the question, you will be told that a similar convertible bond without option is having an interest rate of so and so amount. That interest rate in the question is your effective interest rate, and we are going to use that for all our discounting purposes. So you will see in the question a clause such as a convertible instrument without option, a similar convertible instrument without option is having so and so rate. That rate is what we are going to use for our discussion or our discounting purposes. Now, having ascertained the use of these two rates, how do we split the compound instrument? How do we ascertain the liability component? We discount the cash flows of the instrument, and then once you have discounted the cash flow and sum everything together, that value you have gotten becomes the liability component. So more or less, we are looking at the initial measurement. Now, let's take for instance that entity issued $10,000 10% convertible bond, and a similar convertible bond without convection is having an interest rate of 20%. How will you ascertain the liability component? In this case, we can know that our cash flow is going to be the coupon value multiplied by the coupon rate of 10%, which is going to give us 1,000. So we need to construct a table. Let's say the bond is having 3 years maturity, or is having a 3 years maturity period. So we have year 1, year 2. What are we doing? We are looking at how to ascertain the liability component. So we have our cash flow over here. We have our discounting factor, mostly given to you in the question. And then we have our present value over here, the present value. So let's continue. Let's go. So cash flow in year 1 will be 1,000. In year 2 will be 1,000. But remember that in year 3, the entity will pay both the interest and the principal. That will be the cash flow for year 3. So year 3 is going to be 11,000 here in this question, because the principal will be 10,000 and the interest will be 1,000. So that will be the cash flow. Please, all compound instruments, how to split it follows the same procedure. Now, don't forget, we are going to use the effective interest rate for the discounting. And we all know that the discounting factor is 1 divided by 1 plus r, always to the power n. So if you are in year 1, this will be 1. So let's assume we have it here. We have our discounting factor, and we are having this to be 900, this to be 800, and this to be 10,000. And this, if we sum everything together, we are going to get, this should be, let's say, 8,000. So this plus this will give us 1,700, plus this will give us 9,700. So this is the present value. We are assuming. Okay. So automatically this becomes the liability component, and the equity component will be the difference between this value and the principal value. So here, the equity component here is going to be the 3,300, because if you add this to this, you get our compound instrument of 10,000. So this is how to ascertain the liability component, and then we take it from the compound instrument given to you, the nominal value, to ascertain the effective interest rate. Now, subsequently, so this, if you want to present this initial measurement, then the entity is receiving cash. Okay, the entity is receiving cash, so we are going to debit cash, a cash of 10,000, and then we will credit equity, with 300, and then you credit liability with 9,700. That would have been our initial measurement. Then subsequently, we don't do anything to the equity component. We do not do anything to the equity component, but we subsequently amortize the liability component. We subsequently amortize the liability component. And just as we have done under the financial liability, is the same thing we are going to do here. We are going to amortize. But here you have to bear in mind that if these liability components will be converted into shares or not, and when will they be converted into shares? Assuming that this is 3 years and they will be converted at the end of year 2, then we need to prepare our amortization schedule to the end of year 2 to get the value of the liability component at the end of year 2, so that we can now convert that liability at the end of year 2 into the available equity shares. So we will take a practical question and look at how the conversion is done and other important provisions of the standard. Now, let me pass this. There will be sometimes that there will be transaction costs in the question. When there's a transaction cost in the question, this is how we deal with it. We only apply the transaction cost after you have splitted the compound instrument into equity component and liability component. You only go for the transaction cost. You only deal with the transaction cost after you have ascertained the equity component and the liability component. Then, after you have ascertained the liability component and the equity component, you now prorata the transaction cost by lessening it from the equity component, but we are going to prorata it. In this case, let's assume that there's a transaction cost of 200. Now, this 200 must reduce both our liability component, then our equity component, because we see it to be we see it to be a cost to us, and it must reduce these two. Now, how does this reduce it? If we want to reduce this one, we are going to take the 9,700 all divided by, so this is going to be minus 1,700 all divided by 10,000 multiplied by 200. So whatever we get is what we will less from this. When it comes, it's going to be 300 all divided by 10,000 multiplied by 200. Whatever we get is what we will less from the equity component. That is how we deal with transaction cost in case there is one in compound instrument. In case there is one in compound instrument. All right. So I think the theory, the principles have been established. What is left is to take a practical question to so we can establish more, or we can expand further our discussion on compound instruments. So let's go for the question on the screen. Okay, so let's establish our understanding with the question on the screen. So here on 1st January 2021, Daniels issued 50 million 3-year convertible bond at par. So here Daniel is issuing a 3-year convertible bond at par. So don't forget how it is what's being issued. Now let's look at the other components of the instrument. There were no issue costs. So here in this question, there's no issue cost. The coupon rate is 10%, payable annually in what? Annually in arrears. The bond is redeemable at par. I've indicated this in our financial liability lesson, that we barely have to ascertain or determine how our liabilities will be redeemed after the maturity date. So here in this question, after the 3 years, it's going to be redeemed at par. That means the coupon value must be equal to the redeemed value. We know that we also have it when it is redeemed at premium and when it is redeemed at what? Discount. And I've extensively look at that or talk about it in the financial liability component. Okay. Now, bondholders may opt for conversion in the form of shares. So here, like I indicated in our discussion, here the holders of the bond may opt for conversion. And if they do so, they said that the terms is that every 2 shares for $1 bond hold or liability held, and this is supposed to be valued at 0.25 cents or $0.25. $0.25. All right, and then bonds issued by a similar entity without convection rights is having an interest rate of 15%. 15%. So here there is 15% of our effective interest rate. And also, we should assume that all the bondholders opt for conversion. This means that it's not always the case that bondholders will opt for conversion. Some may opt and some may not opt. So, by in this question, all bondholders are opting for conversion. So, how do we deal with this? First of all, we have to ascertain the liability component. Then we take it from our coupon value to get the equity component. How do we do it? Let's dive in. We are taking 3 zeros away, so let's take 3 zeros away. So our cash flow here is going to be the 50,000, which we are taking 3 zeros away, times the coupon rate of 10%. This is going to give us 5,000. Then we construct our table to ascertain the liability component. So this will be our cash flow. Our cash flow over here. So we have year 1, year 2, and year 3. Year 1, year 2, and then year 3. Now remember that this cash flow is going to be 5,000 in year 1, 5,000 in year 2, but in year 3, which is the last day, they are going to pay both the interest and then the principal. So this is going to be 55,000. Now what is our discounting factor over here? We are going to use the 15%. 15% over here, and here we are going to use we are going to find our present values over here. All right, so let's start. So this is going to be 1 divided by 1 plus 0.15 all raised to the power 1. So 1 divided by 1 plus 0.15 raised to the power 1. Okay, so this is going to be this is going to be 0. We are leaving it for decimal 0.8696. So we multiply it by the 5,000. So multiply by the 5,000, and we are getting 4348, leaving it at a whole number. Then we go to the second one. So we will change this one to 2. So 1 divided by 1 plus 0.15 raised to the power 2. So 1 divided by 1.15 raised to the power 2. And this is giving us 0.7561. Let's do the last one at once. Yes, 3 is giving us 3. And this is going to be 0.6575. Okay, so 5,000 times 0.7561. And this is giving us 3,781. And then the last one, 55,000 times 0.6575. And this is giving us 36163. 36163. All right. So we have to sum up everything over here so that we can get the liability component. So 4348 plus 3781 plus 36163, and that is 44,202. 44,292. So automatically this becomes the liability component, and then our equity component will be the we take this one from the coupon value. So this minus 50,000. So we are getting 5,708 to be our equity component. All right. So we can do the initial recordings or initial entries. So we are going to debit cash. Of 50,000, and then we will credit our equity with $5,708, and then credit our liability with $44,292. 892. So these are the initial entries. Now that we have been able to split the equity, we have been able to split the compound instrument into equity component and liability component. Then we need to now subsequently amortize the liability component. And the payment, remember, is done in what? In arrears. So let's go. So we have our year over here. We have our year over here. And we have our opening balance. We have our finance cost because this is a liability. Our finance cost over here. And then we have our cash payment. And we will have our closing balance over here. Remember, we are dealing with year 1, year 2, and then year 3. Okay. So the opening balance here is going to be 44,292. Don't forget, the finance cost is going to be 15%, and the cash payment is going to be 10%, which we have already determined to be 5,000 here, and 5,000 here as well. Okay, so let's start by taking 44,292, we multiply by, so here we are getting 6644, so 6644 plus 44,292, then we take away 5,000, we are getting 45,936, 45,936, so this is going to be 45,936. Now we take we multiply by 1 point, the 15% again, we are getting 6890. So 6890 plus 45,936, all these minus 5,000. And we are getting 47,826 over here. This becomes the opening year, 47,826. So 47,826, we multiply by the coupon rate of the effective interest rate of 15%, we are getting 7174. So 47,826 plus 7174. Then we take away 5,000, and this is giving us exactly 50,000. And this is indicating that we are correct. Because at the end of the period, since the payment is going to be at par, we should be able to pay the same coupon amount. Okay, the coupon amount should be the same as what? The redeemed value. The coupon amount should be the same as the redeemed value. Now let's look at how we will deal with the conversion. So don't forget, at the end of year 3, this is what the entity is going to have. Year 3, we are going to have, let's take 3 zeros here. We are going to have equity of 5708, liability of 50,000. Now, what is going to be our ordinary shares? Our ordinary shares over here. We don't know our ordinary shares over here. So, wait. So this, if you sum this up, this is the end. Okay. If you sum this up, you are going to get 55,708. That is what we are having as at the end of year 3. Now they said that, so let's look at how many shares converted. So let's look at shares, the shares converted. Okay, so they said that every 2 shares for $1 a liability held. So, okay, every 2 shares for $1 liability held. What it simply means is that we are going to multiply 2 by the 50,000 that we have, all divided by 1. So this is how we do the conversion. This is the liability. They said every 1, so we have to multiply. Then we are going to get here 100,000 shares. They said all these should be valued. So what is the value of these shares we have converted? All these should be valued at $0.25. So all these multiply by 100,000, and this is going to give us 25,000 shares. So out of the total of this, we have converted the 50,000 to 25,000 shares. Then the remaining will go to what we call share premium, share premium, share premium. So we take it from here. It's going to give us 3708. So 3708 will go to share premium and this will go to ordinary shares. So basically this is compound instruments, how to split it and how to do the conversion in case that is one of the clauses in the question. Please do not forget to subscribe and follow. So in our next lesson, we are going to proceed with financial assets. When we are done with financial assets, then we look at impairment of financial assets, how we would deal with credit risk, which is giving rise to credit loss. So we look at life expectancy and credit loss, 12 months credit loss, and we look at derivative hedge accounting and embedded derivatives. So in our subsequent videos, we are going to take each of them. Do not forget to subscribe. Please share. Thank you.